Hello, everyone, and welcome to the New Growth Women's Business Center's webinar series. The New Growth Women's Business Center serves 13 counties in rural Missouri and 2 in Kansas, and I apologize for my voice. We offer technical assistance, networking, capital, and business training. And today we are excited to learn with Cory Gayman, who's a certified public accountant and owner of the JCG CPA firm. Cory is here to help get your business ready during the end of the year tax prep and what you should be prepared for. We are encouraging questions throughout this webinar as he will be answering them as they come in. We're going to take pauses, so guys, feel free to leave those in the question and answer section. This webinar is being recorded and the recording will be available on our website at the end of the day. And without further ado, I'm going to turn it over to Cory Gayman.
All right, Lincoln, thank you very much. And really thank you to the Women's Business Center for putting these on and just for all the work they're doing here in our rural communities. They kind of came in under, they're not quite as noticeable as they might be, but they serve so many counties and so many people around here. We're really thankful to have them in our small town. So thank you very much. Yes, like she said, I do want to encourage questions. Last time I did one of these, we did more of a presentation, but I'd really like this to be more conversational. I think I can give better answers to what you're specifically wanting to know. So please fire in any questions as soon as they pop up. And if she wants to break in, she will. Today, our topic is end of the year tax considerations and getting your books in order. So I'd like to touch on 3 big topics. One is bookkeeping in general. What is it? Why do we do it? The next topic would be strategy. Why end of the year? Is there some strategy that can be put into place that helps you? And then the last thing I want to talk about is timeliness, and why is it important to have your books up to date timely? How does that flow in with the strategy and with the bookkeeping? So I want to hit those points today, and feel free to fire in questions just as soon as they pop up. Just one second here. So bookkeeping. December and end of the year is a great time to get your bookkeeping in order. Most of the time is when the documents start coming in. There's a little downtime. Maybe your bookkeeping firm or you have a little extra time around that period, depending on what business industry you're in. Retail, not so much, but potentially some service industries have a lull in December. We definitely do. It's the calm before our storm when tax season hits. So it's a great time for us to get your books up to date and get you ready to go. So most small businesses are either doing their own books or they're hiring a firm to take care of it for them. We work with many small businesses and in a range of industries, and most all of them have some sort of bookkeeping. Either they're doing it in-house, we're helping them, or we're doing the full thing, the full process in our house. And this time of the year, again, is a slow time for us. So this is the best time for us to do it. Occasionally, we get something dumped on us in January or February that is a big project, and it's hard to stop everything else and do it. So this is really a good time for that. So let's just jump into bookkeeping. What is it? What does that mean? We've all heard the terms bookkeeping, accounting, profit and loss, income statement, all of the accounting terms that made everybody's eyes gloss over when they were in school. Well, we like those terms. We get excited about them. Bookkeeping is really an age-old process, goes all the way back thousands of years. There were businesses and people had to keep track of what came in and what came out. So on the very basic level, the cash in and the cash out. And if you have any left over, you made a profit. So there is more to it, of course. That is basically called a cash basis taxpayer. And most small businesses and individuals are cash basis taxpayers. So when you're keeping your books put together, basically you focus on the bank reconciliation. And that is, again, something that really all school teaches everyone how to do a bank reconciliation. What went into your bank account, what came out, what is outstanding, what might be an error or might be an omission in there. So what we use generally is QuickBooks, and many of our clients do QuickBooks or Quicken or another appropriate program. And we reconcile those bank accounts. We believe if we can get those reconciled, then we've got almost everything covered. Occasionally something comes in that wasn't part of it, but we've got almost everything covered. So the bank reconciliation helps us to find mistakes, duplications, or omissions. And even today, QuickBooks Online and other online type bookkeeping softwares, they will download your transactions automatically for you. So it's become easier for us to work with you and have that bookkeeping process a little more efficient so that we can focus on other things that are more important, like strategy. It also allows some of our clients to prepare their own books, and we jump in and review them. So it makes that process a little easier and more cost effective for our clients. What happens though is not everyone is cash basis. There are some other factors that come into play that will affect your tax return. There's a term called accrual basis, which that means, it's an accounting term, of course, that means that you recognize revenue when you bill it, not when you receive it. So if you send out your invoices, that's when you are going to pay tax on that money. Even if you don't get it right away, or if you get it down into the next year, you're going to pay tax in the current year. The same thing happens with bills that you might owe. You would deduct them when they incurred. So if you got the invoice and you got the service in December, but you didn't pay that bill till next January, based on the terms of your agreement, you can deduct it in December. You match it up with the revenues that came in December. That's a really quick version of what accrual basis is. There are many pieces to that. But another one that affects most of our small businesses is loan interest. And this is something that really can get tied out in that end of the year bookkeeping process. It's very important for your tax return, but during the year, you're just making that full payment. You're paying principal and interest throughout the year. And if it's a mortgage, it might even have taxes and insurance on it. So those are current year expenses. But the principal portion is not deducted the same way the rest of it is. Interest, insurance, property taxes, those are all period expenses. And so they get expensed right away. But that principal, that was for the purchase of the building or the purchase of the vehicle, whatever your purchase was. And so that's actually deducted a different way in what we call depreciation. The point being is we have to adjust those payments that you've already made throughout the year and make sure the expenses go in the right place and the note payable is reduced. So I know I'm throwing out a lot of terms here. Really, if any questions pop up, please fire them in, or if any clarifications, of course. Another big factor to bookkeeping, and this is kind of the curveballs that come at us at the end of the year. So we want to address them right away. Credit cards. Some people have a business credit card for their business and they run all their transactions through it. However, it never made it to the books. So it's a good time to get those credit card statements or even download those as well, or work with your bookkeeping firm or your CPA and give them those statements and allow them to put your transactions in, because those are definitely deductible, but they're not in that bank reconciliation. In the bank reconciliation, you only see the payment. You don't see the detail for those expenses, which is important. Another thing would be cash payment receipts. And this is the hardest one. I think I tried nailing this on our last webinar, that don't use cash. Please don't use cash. It is extremely hard to track. It's very hard to prove. And almost every time, if you tell the IRS, I paid that with cash, they just throw it out because you can't prove it. Short of having a picture of the person and a picture of the item and a signed document that's notarized and all of, you'd have to go through so many links just to make it really work. We do our best, but just don't use cash for business transactions if you can. The only way for us to put them in would be to record them through a journal entry. And either you took the cash straight out of the bank, so that's the other side of the entry, or it was your personal cash, so it's a contribution by the owner. So it makes the books complicated, confusing, and it's extremely hard to prove. So please don't use cash. But that is another thing. We try to see if there are any cash transactions, so we can try to record them. And the last thing I want to talk about, and I touched on it a moment ago, with loan interest, is depreciation adjustments. So depreciation is a multiple year expense. Okay, so I'm gonna dig into this one just a little bit for you. So if you purchase a building, if it's a commercial building, you can't write it all off the first year. That's not an option. You write it off over 39 years. So it's not a good deduction. It's really not. So, you buy a $200,000 building, you're only deducting a couple $1,000s per year or less, just depending on how your calculation shakes out. But if you acquire enough equipment or real estate that is depreciated over multiple years, your tax return, your tax preparer, or a third-party software, you can keep track of all those in there. And you can keep track of the appropriate deduction you get each year. Okay. The big example was commercial real estate, and that's 39 years. But then you have residential real estate, that's 27.5 years. You have general equipment, that's 7 years. Office equipment, 5 years. They all have their own special term, and the IRS spells those out for us. So generally, we know what those are, and you get a depreciation schedule with your tax return to show what was written off this year, where everything stands. And then most softwares will also pop out what's going to happen next year. How much are we going to take on all these assets next year? Of course, during the year, you added to that. And so there's some things to add. So when I say depreciation adjustments and reconciliation, it's quite a process. It really is. But if we can get those in here at the end of the year, you know how it's going to affect your tax return. So we basically, it has to go into a software through a journal entry or just a direct entry to the bookkeeping software. Some businesses like to do this on a monthly basis, so they know where they're at constantly. Some do it on an annual basis. This is an example of a non-cash expense. So, back at the beginning, I mentioned the simplest terms are cash in, cash out. Well, here's an example where cash didn't go in or out, but you still get an expense. Okay. Then another thing is, since we're talking about assets, is what if you sell an asset? So you bought an asset 5 years ago, you've depreciated it over 5 years, and then you want to sell it. Well, there's a calculation there to see how much that's going to be taxable, because over those 5 years, you've been writing it off. So if you've written it off, 50% of it, and then you actually sell it for a gain more than you purchased it for, you have to recapture all that depreciation, and then the gain is taxable as well. So it's a process. And sometimes people forget that when they have a long-term asset that they have already written off and has a zero basis, and then they sell it, say for $100,000. And then that entire $100,000 is taxable at that point because they wrote it off over the past several years. So that is one that we like to know those right now, so we can factor that into a tax estimate for you. As far as bookkeeping, that generally is what I was trying to get across today. What is created from that is a balance sheet and an income statement. And from those two reports, your tax preparer can usually do a good estimate for you and see how it's going to affect your taxes personally or on the business. Most small businesses we work with are pass-through entities where all the income just passes through to the individual. So we would probably ask you a few questions about your personal life as well to try to get or personal adjustments to try to get a good tax estimate for you. So this would be a great time to get any bookkeeping questions out of the way, because we're going to move on to strategy next. I'm going to take a drink while you guys think.
If you were a side gig business, how would you do bookkeeping for that?
A side gig business. So it depends on the level of activity and how involved it is. So if you have a full-time W-2 job and you have a side gig, did I hear that right, Lakin?
Mm-hmm.
Okay, so I'm going to use Uber, for example, because that's a very common one today. You go do these routes and you have some expenses but you're doing it on your spare time. It's not your primary job. So that, with a company that runs it, will likely keep track of most things for you. Okay. There's not many deductions on that. You'll get an income report from them and even potentially an expense report for your miles driven. Okay. Let's take it one level up. And let's say your side gig is a service that you provide. So maybe you wash windows for the downtown businesses. Okay. But it's not your main job. You just do it on the weekends. Well, you're going to have income and expenses for sure. So I would say the very best way to start would be to set up a separate bank account, regardless if you have an official entity or not. Maybe you're just a sole proprietor doing business as, Joe's Windows Washing or whatever it is. You don't even have to have a name. It doesn't matter. But if you have a separate bank account and you can isolate all of the transactions oh, that's ideal for a bookkeeper, because you can just give us those bank statements and say, look, everything that went in here was income, everything that came out was expense, except for maybe your draws, your personal money. You're like moving it to your personal account for personal reasons. If you could point those out, then we're good on that. But that's the best way for this. The simplest way to do bookkeeping is have a separate bank account and have that bank account create a permanent record for you in those statements of what it is. Then as your level of activity increases, potentially you want a QuickBooks or another software. QuickBooks has one offering called Simple Start, which I'll admit is a little frustrating for us to work with because many features that we're used to are not in there. But I believe it works relatively well for these entry level of activity side gig jobs. It even keeps track of your miles. And I think it only costs like $10 a month or less. So there are free options as well. Zero Accounting Solutions is another one, starts with an X, Zero. There are a few like that can help you at least get your bank transactions in and get some totals. Okay. End of the year, what your accountant wants to see is totals of those expenses, not all of your individual transactions, unless you're going to pay them to do the books for you. When we get a box of receipts, it can be very frustrating to have to go through and add all that up. And honestly, you just see it in your fee is what you do. Hopefully that answers the question on a few different levels.
I was going to ask something along those lines and you answered it. So I'd say it was good. And I don't see any more.
Okay. Very good. Before we leave bookkeeping, just the importance of it is that it is done. And if you don't do it kind of in the fall, it needs to be done before your taxes are done. And so sometimes that creates a rush. So we'll talk about that when we get to timeliness a little bit. The next thing we'll talk about is strategy and why bookkeeping is important, especially at the end of the year. Well, you may be in a position where you have a high income this year, or this was the corner turning year for you. You're, for the first time ever, you've actually got solid income and you're making profit on your business. Well, along with that comes taxes owed. And it's not a surprise. It shouldn't be. But we don't want it to be a surprise on due date. We want it to be, okay, looks like you had a great year. Let's talk about, what do you want to do with this? And one of those options is pay taxes, and that's okay. I have a lot of different philosophies from different industries and from different clients about what to do when they have a high income for the year and they think they have taxes due. One of those is just pay the taxes and keep working hard and keep making more money. Another is to reinvest in your business. That's the best way. That's the best way to bring your income down while creating more income for next year and the next year and the next year. So occasionally this decision comes down to what stage of life is your business in? What stage of life are you in? Are you close to retirement, or are you in the first couple of years where you're pushing hard to grow as big as you can? So what we try to do is present you with the information, talk about what your options could be, but ultimately the decision is yours. I bring this back to my farmers quite a bit. They just don't want to pay taxes. And I understand nobody likes to pay taxes at all, but I don't want to advise you to spend money on something you don't need. This has really always been a sticking point philosophy for me, that I'm not going to tell you to go buy something. I'll tell you as you stand, this will be your taxes. If you decide to buy something you needed anyway, I could say, okay, if you want to reduce taxes, do it this year. If you'd rather use it next year, do it next year. What's next year look like? I mean, sometimes that discussion turns into what does the following year look like? And if I get back from the client, oh, I've taken on new projects, new clients, I'm going to make twice as much money next year. Well, then don't use your cash for your deduction now. Hold off until January or February to buy the new equipment or the new service that you need, or sign up for the new program that you think will propel your business. I prefer to be more of a business advisor instead of just let's get your taxes to zero. That's just not a good philosophy. So this is why the books are important, though, to have a complete set of books that is up to date, has taken consideration all the things we talked about a moment ago: depreciation, interest adjustments, everything that's going to affect your taxes. we're doing that so that we can make these decisions. Okay. And this is also where that cash basis, accrual basis is important as well. Mostly cash basis taxpayers get these options. Accrual basis, you're on a month to month, your business is really usually rolling at that point, and it's a little bit different strategy for you. This time of year, though, and to move into the next stage, it's just a good time to do it. Your CPA is generally much more available. The last few years have been difficult all year long because of some of the shutdowns and due dates, but this, tax season's over, extension deadlines are over. And we're not seeking things to do because we are, trying to relax before the big storm comes, but this is a good time of year to get their attention and get some focus from them. On strategy, I think this is a good time. If you guys have questions, this is a place where I would expect a few questions because everyone's situation is particularly different. And we'll say you've heard my philosophy. Many tax preparers, and it's been the historical tax preparers that it is, let's get to $0 every year. It's not the best business decision, even if you feel like it's the best tax decision.
Why is that not the best business decision?
Well, moving forward, again, like I said, the conversation sometimes turns into what's next year going to look like. How much income do you expect next year? Well, maybe pushing forward, you could still buy that piece of equipment that you think you need, but use it in next year's deductions, because next year might have a higher tax bracket if you make more money. Or you might decide you want to pay zero taxes and you have $100,000 profit. So you want to buy a $100,000 piece of equipment that you don't really need. It's kind of a duplication, or you just want it, or you just want a new one, or you just want a brand new truck. Well, avoiding taxes, say avoiding, that's probably the wrong word, but reducing taxes is not that's what I'm saying. It's not make the best business decision if you didn't really need a new truck. If your current truck was perfectly fine. Again, it's the client's decision. Our job is to give you the information. The bookkeeping's job is to give you the information needed to make that decision.
What if something happens in their future and they go to sell next year and they've showed $0 every year? How's that going to look?
Absolutely. That's another point. And it's not just that, it's also banks. And the last 10 years, we've really run into where people can't buy a home if they're self-employed. They just can't buy a home because the bank sees, well, you lose money every year. Why would we loan you money? And so then you're like, well, I wrote all this stuff off because I didn't want to pay taxes. Okay, well, I don't think you make money as the banker. So getting a loan or qualifying for a loan, and there are other, even if you want to sell, the buyer wants to see the past 3 years tax returns, and they want to see the past 3 years profit and loss. So you'd have to have a big discussion and explanation if you show losses every year. So yeah, it creates a lot of problems, and it creates a zero basis for you because you already wrote everything off. So if I wrote everything off, I have no equipment on the books, but I'm selling this company for $500,000. Oh, there's $500,000 of taxable income because I've already written everything off in the previous few years. And the problem that creates is those previous years, you probably didn't have a very high tax rate. But the year that you are making a lot of money and you get that big sale, your tax rate is going to be 3 times what it was. So it would be nice to have some of that deduction in that year instead of those old years.
And we have another question on here. How often should you meet with your accountant to be best prepared? Should you only focus November through February?
No is the answer. So I would say a more of an ongoing relationship. It breaks up nicely in the calendar to, I'd say, a minimum quarterly if you are a small business. Many of our clients we work with monthly, and some we even work with on a weekly basis to keep them up to speed. It depends on your level of activity, and it depends on your staff, which includes you. If you're running your business, can you keep your books up? Is that a possibility for you? Or can you hire someone to keep your books up? If you need the accounting firm to do it, once you present it to them, collect it and give it to them, they're going to have to work on it. So time just keeps clicking away. The days keep moving along. So many times we get clients in a panic or an urgent situation at the end of the year because it wasn't kept up throughout the year. Much, much better for you, a staff member of yours, or the accounting firm to have been working on this all along. And I'd say a minimum frequency of quarterly. A meeting isn't necessarily quarterly, but just getting the books up to speed quarterly. That'd be my recommendation. And that's the minimum, of course.
I don't see any more questions, but guys,
Okay.
feel free to jump in at any point and put them in there.
Yes, absolutely. The last topic, I've kind of been hinting at it a little bit, really is timeliness and why it's important. And that question actually kind of answered a lot of what I have in this section. What happens in our world? And I kind of want to present it from our perspective. December, November, pretty slow. We're kind of getting our tax software ready. We're reorganizing the offices. We're making any adjustments we need to prepare for tax season, hiring more staff to take on any growth we expect. And then tax season hits. And then it's suddenly every day we have hundreds of tax returns dropped off at our offices ready to work on. So a lot of times we try to do those immediately and in order, of course. But if we get something that's a big project that's going to take multiple days, well, it can be a little frustrating if, well, we could have worked on this back in December. We could have had all that done. And then now it would be really easy to just finish it up. So the timeliness of this, if you're going to have a big project of the full year of books that you maybe aren't equipped to do or don't know how to do, or you want to pay to have that done, contact your bookkeeper in November and December, October, November, December. That's when we're the least busy. It's a project that we can give to a staff accountant of ours to keep them busy. And we want to keep our staff employed all year. So that's a big part of it. But once we get into tax season, it almost feels unfair to the other clients who are giving us a clean project just to roll with. Instead, we're getting a messy project. So many times, and I'm being a little honest here, really, many times the tax preparers will set those aside and they will ask for an extension, ask the client, let's do an extension. Let's focus on this better later, because this is going to take some actual strategy and thought that really I wish we would have done back in December and November. But let's extend this. Let's do it in the off season when we can focus for you. Because right now we have people in and out the door constantly ready to get their taxes filed. And it's also the time when all the individuals come in. Individuals that don't have small businesses don't generally need tax advice at the end of the year. Occasionally with a retirement or an inheritance, a few things like that do pop up, but they don't need every single year. They don't need a meeting or some advice. So, but they are all coming in between, February 1 and April 15th. So we feel a duty and responsibility to take care of them right then. So the timeliness topic here is just, I'm trying to give you our perspective of it. Bring your stuff in now. Let's get it done where we can focus on it, or you work on it now instead of you working on it in February and March, and then you bringing your project to your accountant at the end of March or close to April, when, let's be honest, we all get a little fried at that point. And so the earlier we can actually do the tax return, the better. And this is just getting it up to speed right now really helps push that forward. Any questions about just general timeliness or really anything? This is kind of the end of the content I have for you. So open for any questions.
Do you ever recommend people paying in quarterly, like to the IRS?
So it depends on your legal structure. It depends on your entity legal structure is what I mean. If you're just a sole proprietor and you have a small business, Schedule C, it's just you. Yes, you probably do need to, because you'll have a profit at the end of the year and that self-employment tax grows really fast. It's 15% of your profit. And then it goes to your income taxes, which that could be another 15 or 20% there or higher, depending on how high your income is. So that could be up to 40% pretty fast of how much you need to pay in on that self-employment income. So for self-employed sole proprietors, generally paying in quarterly is the best idea and your only option. But how that usually comes from us in a realistic standpoint is the previous year when we prepared your tax return. We might have asked you a couple of questions. Hey, what's next year going to look like? You're going to make more money about the same. Well, we print out some vouchers for you to do that and some estimates of what you should pay throughout the year. Sometimes those need adjusted. So you might call and say, I got a really big job. My income just doubled. Okay, we need to adjust those. And you pay those in, and those are estimates. And at the end of the year, you reconcile up with the tax department. Now, a different legal entity might create to where you are an employee of your business. C corporation or an S corporation will create to where you're an employee. And at those times, you don't have to pay in quarterly because you're already paying in monthly. You're paying in the withholding that comes on your W-2 paycheck is getting paid in monthly. So what I like to do with my clients is work out what we think their tax will be, and we work that into their W-2.
Okay. When a sole proprietor is in selling only to tax exempt nonprofit entities, is there a need to file quarterly since there is no tax due in each of those quarters?
So are you saying that the client is the nonprofit? Is that how that reads?
I'm reading it as they're only selling to nonprofits. They're selling tax exempt.
Oh, okay. Yep. So you might be confusing income taxes with sales taxes. So sales tax is a totally different department. It's with your state. So here, the state of Missouri wants their portion of sales tax that you collected throughout your sales. If you're only selling to exempt employees or exempt businesses, then you probably just file a zero sales tax return every time. Now, let's not confuse that with income taxes. That is your business that's not a nonprofit, a for-profit business. The sales you make to those nonprofits, that's still taxable to you because it's your income. Okay. They just don't pay sales tax on it. That's just a whole different topic. But if you are generating money from a nonprofit and you are for profit, yes, you need to pay in quarterly or monthly, just like every other for-profit business.
And then she also said, what is the threshold for when you need to pay taxes? New, very small business, just getting started.
Yeah, so again, it really depends on your entity structure. So I will assume you're probably sole proprietor at this point, Schedule C. It's very likely your first few years you even have a loss. It's just common because you're investing in your business, you're getting it going, and that's not a bad thing. A lot of people hear that you didn't make any money and you're worried about it, but you might have bought some assets. You probably have some things of value sitting there ready to, use or sell if needed. So the threshold, every individual gets a standard deduction of about $13,000. However, that does not affect your self-employment taxes. So I'll just give a few number examples. If your business profited $10,000, you will definitely need to pay in that self-employment tax, which is about $1,500 because it's 15%. Then it goes to your income taxes and it might get all wiped out by your standard deduction at that level. But your self-employment tax will not get wiped out by your standard deduction. So I'd say when you're closing in on the $10,000 profit range, you really need to start considering, okay, how are we going to pay these taxes in? Or am I covered by my child tax credits? Or there's a lot of other individual credits and payments that might come into play there, but that'd be up for a big analysis of your whole situation.
This one says, I just started selling at a farmer's market. Do I need to be charging taxes on sales to customers?
So sales taxes, again, so different topic than income taxes, sales tax, but very likely, yes. The answer is yes. That does depend on your state and your county. But most states definitely want sales tax on every retail sale in their state. There are some exemptions, but farmers markets are generally not one of those as far as I know. And not only the state, unless they have special rules, that county that you sold it in and that city that you sold it in, they want a portion of theirs too. So you really are supposed to keep track of what you sold where, but very specifically to the county or to the city, and sometimes even the district. Sometimes if there's let's say the city built a farmers market district, but to help pay for it, they put a small sales tax on there for that special district. You might have to pay tax on that too. A good way to look these up is from, at least Missouri does. There's a lookup function on Missouri's website, and I think most states do, where you can put in the specific address that you made the sale, and it can tell you what the sales tax rate was there. Now, you might get exempt clients that walk up, or customers that walk up and say, oh, I'm exempt, I'm a farmer, or I'm exempt for whatever. Get the piece of paper where they declare that, because you could be in trouble if you're just saying, no, those are all exempt, but you don't have any proof of it. Missouri has a affidavit form that they fill out, put their information on, and they sign it, and they give you a copy. As long as you retain that, then you don't have to pay tax, or they don't pay tax. Remember, sales tax is not your tax. It's the customer's tax. You are just collecting it and then sending it to the state. It's a fiduciary responsibility of the business owner to collect that and send it in.
And to touch on that, the way that we explain it is typically if you're handing over a product to someone, you're going to probably be paying the sales tax on
That's the
it.
same, yeah.
Any other questions? I don't see any.
All right.
Last chance, guys. He
He
looks like he wants to answer at least one more.
We're good, sure. I would just encourage everybody to contact their preparer or advisor, or just be in touch with somebody about getting your books ready to go. Because if you try to do all of that during the busy season, it almost doesn't matter what tax preparer you talk to. They're very busy at that point. And it can be frustrating if a new client walks in and tries to press that urgency upon us when we already have a lot of urgency going on. So we would much rather help you now when we can focus on you and give you good advice. And we know you appreciate that tone from us a lot better when we can actually give you good attention. And really, the better prepared you are for your tax return with a clean profit and loss, income and expenses all totaled up, the cheaper your fee is going to be. Absolutely. When we get a box and we have to do all the work, the fee usually triples.
Okay, well, if you guys don't have any more questions, Cory, are you done?
I'm good. Yeah, no, thank you very much. And really, you guys are doing awesome work there. So thank you for what you do.
Thank you. Thanks for partnering with us. Thank you, everybody, for attending today. It looks like we had a good turnout, and thanks for the questions. This recording will be available. We'll send it out to everybody who registered, as well as on our website. You can find us at New Growth Women's Business Center on Facebook. Cory, you got a Facebook handle?
No, not yet. We're working on one. We do have a website, jcgcpafirm.com.
Yep, you can check him out. You can schedule on there. You can set up an appointment for business counseling on our website. So anything you guys may need, just holler at whichever direction you need.
And we work with a lot of clients remotely. So we have our processes on there of how you can set that up. We work with clients all over the country.
Awesome. All right. Well, thank you guys.
Thanks,
have a good afternoon. Thanks, Cory.
Bye.